Good morning, everyone, and welcome to a nice sunny Friday in Durban. Today, we're going to be going through a little bit about retirement and investment. For those of you who don't know me, my name is Gary Watkins, and I'll be doing the presentation for today. I just want to quickly get onto my slideshow. If you can hang on 2 secs, and we can get cracking. Fantastic. So guys, that was just a little introductory video basically into our company or group of companies and all the different facets of financial services that we represent. We basically have 8 financial services companies that handle each aspect of a different financial service. So if you want medical aid, there's a medical aid division. If you want to do stockbroking internationally, we have a stockbroking business. So what's very nice about this is that when you're dealing with Quattro, you're dealing with a specialist who handles every aspect of your financial service and then hands over to the next specialist who handles the next section. So you don't end up dealing with a generalist who can do a little bit of everything, but not fully understand your needs properly, because it could end up costing you significantly more money if you make any errors. So getting on to what we're going to be discussing a little bit about today is more about retirement. There's been lots of speculation around retirement, different types of products, the way you plan. And what we want to do today really is just firstly understand how you need to retire, what sort of lifestyle you want to live when you retire, and also to get some perspective on timing. I think what's very crucial and what a lot of people don't understand when planning for retirement is how important every single day that goes by is to ultimately achieve your objective. So if you just look at this little graph here, it'll maybe just depict the urgency for you to start getting your retirement savings done. And even for your friends and family to share this information with them. If you're 30 years old, you've got 420 paydays and you're going to be on pension. Now, why this is important is because each payday is the day that you would have your debit order going off. You only save for retirement once a month when the debit order goes off into your bank account, or off your bank account into your retirement account. So your retirement piggy bank, if you're 35, is going to get 360 deposits in it, and then you are going to be on retirement. If you're 40, you've got 300 opportunities to save before you retire. And if you're 50, you can see the result there as well. So I think what's crucial is to understand time is not that you're saving today and saving tomorrow and saving the next day. Time needs to be only 12 measurements a year, 12 deposits, 12 opportunities per year. And each year that passes, you've missed 12 opportunities to save. And this compounded effect over time until retirement has significant impacts on people's retirement savings. So the big question is why do you need to plan for retirement? A lot of people have got the notion that they're going to continue working forever. Now, I want to try and dismiss this notion. And the reason being is that most people would want to work for as long as possible, potentially, because they want to keep themselves busy, have some sort of purpose in their life, and generate some wealth. But the problem is that there are obstacles that are going to inhibit your ability to work. Things like deteriorating health. My dad suffered from early stages of Alzheimer's, and as a result, wasn't able to work efficiently and properly like he used to do anymore. My dad also got ill. He had heart conditions. He had stents and a heart attack. So he was unable to fulfill his ultimate goal of working until death. And at 65, he basically retired. And when he retired, he lived until he was 74. And those years of living, he had not saved up enough money for his retirement because he honestly thought he'd still be working and earning a living. So if you would like to work until retirement, what we advocate is still have a plan that gives you the opportunity to not work. And if you do work, you're working for fun, not because you have to work for financial reasons. Another very important aspect of retirement, people underestimate how much money they need when they retire. Remember, when you retire, you're not expense-free. Hopefully, by the time you retire, you've settled your bond. Maybe you've paid off your vehicle, so you're debt-free. We hope the children have left home by the time you get to retirement, and you don't have to look after them anymore. But you've still got all your living expenses. You've still got lights and water, rates, levies, medical, food, clothing, spending money, insurance on your home, insurance on your car, potentially a car repayment because your car might not last you from 65 until you die. Most cars nowadays, 3 to 5 years, people are changing cars. You might need to change your car. You need fuel for the car. So your expenses are still very real. Now, when we consult with people, we find a lot of people who earn, let's say, 50,000 a month, turn around and say, when I retire, I need 20. Now, you've got to really understand 20,000 in the context of your expenses, and is it realistic? Because effectively, you're dropping 30,000 Rand off that person's income. Can they afford just to drop it off? So be realistic around what your retirement expectation is when planning for it. Another very important aspect to always consider with your plan is don't aspire to do the best today and forget about tomorrow. We see so many people that buy the most expensive car they can afford, that buy the most expensive home they can afford, or rent the most expensive home they can afford. They buy the best clothing. They really try and live life today, which is great, but never making provision for tomorrow. And just psychologically, to end up at retirement age 65 and have to hand in the keys to your BMW and go and buy yourself a 30-year-old Ford Escort might not be that appealing. Moving from your home suddenly into a granny flat psychologically affects you because you feel almost like a failure. And there's nothing worse than working the whole of your life to finally get to retirement age and then suddenly downgrade your lifestyle to the absolute bare essentials and live like a pauper. So really, the message is try and have a balance. Enjoy life today by all means, but make provision that you can enjoy that life post 65 as well. And we always advocate having 2 retirement plans: an aspirational retirement plan where you aspire to overseas holidays and all that nice, sexy stuff you want to do, but then also a have-to-have plan for retirement, your safety nets. In other words, the bare minimum, the amount of money that gives you dignity still, keeps you in a car, keeps you in a home, keeps you fed, keeps you clothed. Very, very important. Another huge thing, a lot of people say, when I retire, I don't want to be dependent on my children. I don't want them to have to support me, because this has a huge knock-on effect for them. If they're financially supporting you, it means they more than likely won't have the affordability to make provision for their retirement savings because they're busy paying for yours, which ultimately means that they will end up in the same boat as you, also unable to retire. When you chat with the kids when they grow up, they've got exactly the same mindset. They also don't want us to depend on them because they know the consequences of this. I was in real estate many years ago, 23 years ago, and I remember I grew up in Pinetown, how many homes had granny flats because people just had not made provision, and people didn't understand the effects of inflation and how it erodes the buying power of your money. Inflation is the cost of living, which increases every year. But if your money is not growing at the same rate as the cost of living or more, your money actually gets smaller in terms of a buying power, and you end up getting financially poorer. Even though your rand value gets bigger, you're sitting getting poorer and poorer and poorer. The need for medical and chronic medication post-retirement, also something very, very important to understand. Medical aid inflation is significantly higher than normal inflation rates that we work with. And you've got to make sure that you can afford a medical aid plan sometime in your life now, and also when you're retired. You might be able to downscale your medical aid when you retire, but you can't just not have one, because then you are going to be dependent on your family bailing you out, or you're going to be sitting in the situation where you're going to be going to a state facility or a state hospital to get treatment. And it's not a nice place for elderly people to be put into a position like that. So your medication, chronic medication going forward, as you get older, generally you're going to suffer from more ailments and require medication. You need to make provision for this when doing your plan. Living the life of a surviving spouse, another huge thing. Firstly, when you get to retirement age as a spouse partner, you both would like some form of independence. We've seen a lot of people that get to retirement and they battle as a couple. And the reason for this is that the husband goes off to work every day, comes home at 5, they spend 3 or 4 hours together in the evening, and then they go to sleep. And then they wake up and the husband goes off to work and the wife goes off to work. And then they come back again, regroup as a family for 3 or 4 hours, and life continues with 3 to 4 hours worth of interaction between each other. When you get to retirement, though, you're stuck together 24/7. So now you're in each other's spaces and you find conflict. So we advocate save up enough money to at least have your own independence still, that you've both got your own car, as an example. You can afford to do things with your girlfriends if you're a lady, and with your guy friends. Go and have your game of golf and go and have your teas or shopping or lunches or dinners or whatever you want to do as a couple, and also independently, so that you have got your own space as well. But very important that you plan for that. And then for a surviving spouse, if your partner dies, your husband or your wife dies, make very sure that the provisions that you've made for retirement continue for your surviving spouse. There are many different ways of planning for retirement, and one of them is called a living annuity, and the other one is called a life annuity that most people choose between the two. And in these annuity options that you choose when you retire, there are certain risks associated with them and certain benefits. And it's very important to understand these, because you don't want to either run out of money, or the money stops when the surviving spouse, when the deceased spouse dies, it stops for the surviving spouse. So you've got to make very, very sure and certain that the type of annuity you choose is one that survives you and your spouse. So a joint survivor annuity, if you choose a living annuity, might be the option. If you choose a living annuity, make sure you've got enough money for you both to survive off, and that there's still enough money for your surviving spouse post-death. Otherwise, you might still need to leave some life cover in your plan. I want to just chat about retirement again, and I want to go back to my father, because it's quite a relevant story. In 1971, my mom and dad bought their first home, and they paid 21,000 Rand for that house. Now, in 1971, 21,000 Rand was a significant amount of money for them. My dad probably earned the equivalent of, call it 700 Rand a month, and his bond payment was a significant amount of money out of their paycheck. And it actually bothered my parents to a point where they wanted to pay their bond off as fast as they could to get rid of this big elephant in the room. The problem is that whilst paying that bond off aggressively, they were sacrificing saving for retirement. So we call it robbing Peter to pay Paul. You've probably heard that before. So you're taking away from your retirement savings in order to settle your bond. And one of the lessons we learned from this is that the bond term was only 20 years. So what we advocate is, when you're buying your home, take your bond payment over 20 years and pay your bond over a 20-year term with that repayment in your mind. Then plan your retirement plan next to it and see how much you have to save in order to achieve your retirement objective by the time you're 65, and get that plan running. Once you are paying your bond at the rate you're supposed to be paying, and you're saving enough money in your retirement savings is what you're supposed to be saving, if there's additional money left over, then you can start to pay the bond off earlier, or you can start to beef up your retirement so you get a better retirement, or you beef up your retirement so you can retire earlier. But what a lot of people have been doing is paying off their bond early at the expense of their retirement. And the problem is, by the time they get the bond paid off, their retirement goal is just too big for them to reach. They actually can't afford enough money to save. Because remember, the retirement plan is the compounding effect of money over time. And that compounding effect is what you lose by not saving right away as much as possible. Now, going back to my parents' house, the 21,000, this massive amount of money, my dad's pension fund was with McCarthy's, and he was going to get 600,000 when he turned 65. So to put that into context, my dad's expectation of retirement was the equivalent of 28 and a half houses. He paid 21,000 for a house, and he was paying it off over 20 years. And when he retired, he would get 600,000 Rand. So that was, for him, it seemed a lot of money. But he did not understand the impact of inflation and the cost of living increasing, and what that 600,000 would actually buy him when he turned 65. My dad retired at the age of 65 and was paid out 640,000. So he got 40,000 more than he expected to get. But his pension was a measly 2,200 Rand per month. It was nothing. It didn't even cover the full premium for the medical aid. So my mom continued to work, and my dad unfortunately couldn't work because of health reasons. But it caused a massive, massive problem for them in their retirement plan, just because they didn't make the correct provision. So I don't want any of you to be disillusioned by that. I would really get counsel when looking at savings. If my dad and mum had kept their bond going in those days at 21,000, that bond payment, if you took a bond today of 20,000, it would probably cost you, worst case scenario, $200 a month. Now think of that in context. If I went to my parents in 1971 and said, Mom, Dad, don't worry about this 200 Rand bond payment. It's going to mean nothing later in life, because what they forgot is their salary is going to increase every year, but the bond payment didn't. The bond payment stayed the same. Remember, bond payments only change if the interest rate changes. So it might change by 1% or so, variable up and down, but it's going to be relatively flat-lined for 20 years. But your salary keeps increasing. And because your salary increases, the percentage of the bond payments in relation to their salary increasing became cheaper and cheaper and cheaper to afford the more they earned. Eventually, the bond payment became insignificant. Today, 200 Rand would buy you 3 plates of sushi. If I went to my parents and I said, your bond payment is so small, in 20 years' time, it's going to buy you sushi, they would have laughed. I replaced tires on an SUV the other day. The tires cost 25,000 Rand. Can you imagine going to my parents in 1971 and saying, you know what? My car tires are going to be more expensive than your house. They would have thought I was absolutely crackers. Yet it happened because of inflation. So you have to understand the effect of inflation when doing your planning with us. I want to show you a quick picture of Usain Bolt, who is the fastest man in the world up until he retired a few years ago, but holds a record for the 100 and 200 meter sprints. Phenomenal athlete. If I took Usain Bolt and I stuck him in front of you on a stage and I said, was he a good athlete? You would say, yes, he was a brilliant athlete. If we look at this chap over here, Eliud, also a phenomenal athlete. He runs marathons. He's won the Comrades Marathon, I think, twice. Phenomenal athlete. If I stuck him up on that same stage, you would say, yes, he's also a very good athlete. The problem is, if I stuck both of these athletes up on the same stage, and I said to you, are they good athletes in each other's races? If we put Usain Bolt into the Comrades Marathon, do you think he would be a good athlete for that race? And I'm pretty sure the answer would be a resounding no. I don't think Usain Bolt could finish the Comrades Marathon. He's designed as a sprinter, short distance runner. Likewise, if we stuck Eliud into the 100-meter sprint, he'd probably do fairly well. He'd probably beat most of us in the room. Well, I'm sure he'd beat all of us. But he most definitely wouldn't feature against any of the other 100-meter sprint runners. So he would be a useless athlete in that race. Now, why I'm sharing the story about the athletes is that when we invest money into a retirement annuity or a pension fund or a provident fund or an endowment policy, whatever we invest in, that money gets invested into what we call a unit trust. So it's an investment. Now, unit trust very simply is, it's a basket of shares. There's a fund manager, let's call it Allan Gray as an example. Allan Gray is a fund manager. They create a big trust and they go buy a whole lot of shares on the stock market. And they put all these shares into this basket. And then you as the investor get to invest in that basket of shares. But you don't have to go and buy a specific share like FNB or Standard Bank. You can go buy a percentage of this trust with all these shares in it that Allan Gray manage, and they decide whether they're going to buy or sell Standard Bank shares or South African breweries or Naspers or whatever it is. But they're trading all the time, buying and selling shares, and you as the investor are investing in their pot. And that trust, when you buy a percentage of it, it's a unit of their trust, so it's called a unit trust. So you actually invested in the market. But now Allan Gray Unit Trust is one of 2,000 odd unit trust funds in the market. Now, each unit trust fund manager has got a very specific mandate. The unit trust fund is designed for a specific term of investment. They might say, we invest for 5 to 7 years, and we would like to achieve an outcome of X. Another unit trust fund would say, we want to invest for 1 to 3 years, and we want a return of Y. when you're looking at unit trust funds, you've got to understand each unit trust fund has got its own race, like the Comrades Marathon or the 100-meter sprint. Each fund manager is like an athlete, a Usain Bolt or an Elliott. And each fund manager has got its own mandate designed for their outcome in mind. I want to run the 100 meters in 9.5 seconds, or I want to finish the Comrades in 5.5 hours. They've got a strategy. They've got an expectation. So when you're comparing investments at the Braai on the weekend, don't turn to your mate and say, I got 18% return last year. What did you get? And if he got 5, tell him he's a poople, because he's not. You need to understand what fund is he invested in and what is the mandate of that fund? What is it designed to do? Because if it's designed to run 100 meters, it's never going to be able to perform at the same rate as one that's designed to run the Comrades Marathon. So if I look at these two athletes again in the two races to give you a bit more insight into how a unit trust fund management needs to take place. Let's look at the 100-meter sprint. The first thing we got to identify is his timeline. He's got 9.5 seconds, 10 seconds to finish his race. It's a short-term investment. It's a short-term race. He cannot afford to take any risks. If he runs down the straight and his shoelace snaps, he's out the race. He can't stop and fix his shoelace. If his shoelace comes undone, he can't stop and retie his shoelace. There's no a time for error. If he loses a half a second, he's lost the race. So short-term investments, don't take risk. There isn't any risk in it. It's a low-risk investment. A short-term race, there isn't any risk that they can take, so there's no risk. No risk, low return. If you want to invest for the short term, you can't expose money to too much risk, but you also can't expect to get a high return for your investment, because risk taking can reward return. But if you don't take risk, the chance of getting a return is very, very small. If we look at Eliud running the Comrades Marathon, he's running for 5.5 hours. He's got 5.5 hours in which to achieve his objective. If his lace snaps, there's a good chance he could stop, find a spectator to swap laces with, maybe even have a bite of a boerewors roll and a sip of a beer, and then carry on with his run and have enough time to make up the lost time whilst he was fixing his shoelace and having his boerie and beer. Long-term race, he can take a bit more risk and he'll get a better return because he's taking more risk. A long-term investment, you can take more risk and you should have a higher return because you've taken the more risk over the period. So that basically explains a little bit about risk and return and time horizon being so important.
Have you ever wondered what ancient Chinese seafaring merchants and the stock market have in common? We thought you'd never ask. In the 3rd millennium BC, Chinese merchants laid the foundations for how most good investment companies approach the markets today. You see, most of the world's traders at that time would try and build ships that were the perfect balance between speed and strength. Speed made sure you got to sell your wares first, but strength made sure you got to sell them at all. Then they'd strap down their precious cargo and head out to face all of the dangers that the weather and the ocean could throw at them. They relied on their seafaring knowledge, navigational skills, ability to adapt, or even just pure luck to get them to their destination. Sadly, sometimes, it just wasn't enough. If a ship sank, it would sink the merchants, financially too. The Chinese merchants had a different approach. Understanding that they faced the same oceans with the same risks that the rest of the world did, they minimized their risk by dividing their cargo amongst themselves. This way, if one of their ships sank, they never lost all of their cargo. They had minimized their risk by not putting all their cargo in one ship. This is the same for investments too. One of the most important considerations when constructing an investment portfolio is how much return investors could expect for the extent of risk they are willing to take. Let's say that an investor has identified 30 stocks with a similar expected return. Research has shown that although the return on the stocks may be similar, the volatility or risk of a 30-stock portfolio would be far lower than a portfolio of only one investment. In fact, in many cases, the 30-stock portfolio would be less volatile than even the least volatile share invested in. That's why diversifying across local and offshore asset classes, such as equities, bonds, property, and cash, is as important. So while many people believe that investing can be risky, it doesn't have to be. With this in mind, we construct well-diversified investment portfolios that aim to deliver optimal returns for the overall risk of the portfolio. And even though there might still be some volatility, diversification significantly reduces your risk of losing your well-earned savings, which makes for a much smoother investment journey. This means that although you won't find your thrills in the stock market, you can find them somewhere else once you've reached your investment goals. So be a Chinese seafaring merchant and stay invested in a well-diversified portfolio.
All right, so diversification is always key. We're going to get onto that shortly. What I wanted just to elaborate on now is just around when risk profiling, looking at the time horizon. How long have you got to achieve your objective? If you're 30 years of age, as an example, and you're retiring at 65, you've got 35 years of opportunity for investment. 35 years to weather the storm. If the markets crash, you've got 35 years before to wait for them to recover. You can take more risk because you've got such a long term. If you were 60 years old and retiring at 65, then obviously it's slightly different. You've got 5 years in which to weather storms and the markets to turn. So you'd probably be more risk adverse when you're older than when you're younger. But risk profiling, really, the results are significant for someone who's planning for retirement. And these next few slides are going to just illustrate a little bit about what I'm speaking to here. So if we look at this example, we've taken that 30-year-old who's retiring at 65, and we're going to invest just 1,500 Rand a month. It's just a random figure, but just to give you an example of what will happen. This 30-year-old investing till 65 is going to save 1,500 Rand a year. And in this 1,500 Rand a year, it's going to grow at 6%. So we would call that a conservative investment, 6% a year over that period, a conservative investment. And he should potentially have it invested a bit more aggressively because he's got a long time period in which to achieve his objective. So what would happen for this guy? He'd get 1,500 Rand a month saved. He would end up with an income at 65 of round about 3,632 Rand per month in today's money. So it's the equivalent of earning 3,600 a month now. If the same investor took a slightly more aggressive approach because someone just told him a little bit about the term that he's got and the fact that he can afford a bit more risk, and he invested in a cautious investment strategy, and let's say, this is just an example again, let's just say he got 10% growth over the period, the 35 years of his 1,500 Rand a month. So it's the same money saved, the same cost to him. He'd end up earning 6,400 Rand a month instead of 3,600 a month. So just to understand, he saved the same money as the first guy, but he's got more, just nearly double what the other guy has got. The same money again, a little bit more aggressive, getting 12% return, would end up earning 8,800 Rand a month. And so it carries on. An aggressive one at 15% a year would end up earning 14,800 Rand a month. So what this is, it's a graphical depiction of who invests, what term, in what portfolio, at what risk to achieve what objective. Do you want to be the guy who earns 3,600 or the guy that earns 14,800? And bearing in mind, it's the same contribution. No one's paid anything more. All that's happened is the growth was bigger than others. So choosing the right investment portfolio is critical. A lot of people focus all their energy on how much they have to save and don't focus enough energy on how is my savings going to do? How's it going to perform? We see young people saying, I'm very cautious. I don't want to take any risk. It's crazy because you can see graphically here the outcome that it'll have for that person if they don't take the risk. Some people can't afford to save more than 1,500 bucks a month. It's not possible. He only earns 10 grand, let's say. He can only save 1.5. The reality is he can't afford not to take risk. He has to just take risk to try and achieve the 14.8 or the 8.8 maybe, or the 6.4. But if he doesn't take risk, he is guaranteed failure because he's guaranteed to only get 3,600 rand a month. When it comes to investing, a client's risk profile is very, very important for us to understand. And this plays true more so if an investor invests a lump sum of money as opposed to a monthly contribution. The two investment strategies are very, very different. Yet so many people clump them into the same risk profile when looking at an investment. So I'm going to give you an example. If I'm investing 1,500 Rand a month, I'm paying 1,500 Rand a month into the Allan Gray Unit Trust Fund, let's say. I'm buying some end of this month. The unit trust fund could be down at the time, so I buy more units for my 1,500 Rand because the unit trust fund is down. Next month it comes up. I'm still paying 1,500 Rand, but because the unit trust fund is doing better, I'm buying less units, less percentage units of that unit trust fund for my 1,500 Rand. And this happens throughout your life. And you're buying every month, every year, depending on where this graph is on this Allan Gray fund, throughout the term of your investment. It's all over the place. That's a recurring premium. In a lump sum investment, you're putting money into the market on a date. So you're buying your unit trusts at a specific price. Now your lump sum is subject to the volatility of this fund throughout your time. So here's an example of an investment of 2 million Rand. Okay. The blue portion of the investment is what we call the equity component. That's like your stocks on the stock market. The red part is property. There's 20% in property, 20% in bonds, and 10% in cash. This is just an example of let's call it a moderate investment portfolio. Now, let's pretend that the markets do very well. The stock markets thrive. But where the growth comes from is from the equity part of the market. Property does nothing, cash does nothing, and bonds does nothing. They just stay the same. And the equity market runs and gets 50% growth on this investment. Bearing in mind, this is a moderate investor. So the person came to us and said, I am a moderate investor. This is the kind of pie chart I need to invest in because this is the kind of risk I'm prepared to expose myself to. Now the markets have run. Equity market did 50%. The equity value, the blue part, has now increased to 1.5 million. It used to only be 1 million. The total investment was 2 million originally. It's now sitting at 2.5 million. But 1.5 million of it is in equity. And then the balance is diluted as a percentage of the 2.5 million. What this pie chart shows you is an aggressive investor's risk profile. If you came to me and said, I'm an aggressive investor, we would invest you in a graph that would look similar to this, where you're exposed to 75% equities, and then the balance between bonds, cash, and property. But let's just go back one step. You are not an aggressive investor. You've come to me as a moderate investor, but you've become aggressive just because of the growth in the market. You didn't ask for this to happen. It just happened. I didn't do anything for this to happen. You just got growth. And remember, as an investor, you are expecting growth. You want growth. So you phone me up and say, Gary, well done. I've made 500,000 bucks. I'm over the moon. My investment went from 2 million to 2.5 million. You've done a sterling job. We all pat ourselves on the back, but the problem is you have changed risk profile. You're now an aggressive investor, which means you now are subjected to risks that you were not prepared to take. So I phone you up and I say to you, listen, you need to bank some of your profit. And you say, hey, don't touch that thing. That thing's doing well. If you touch it, I'm going to murder you. I don't want to lose any money. It's doing well. Just leave it. The problem is, if the markets have a correction and they go back 50%, your pie chart changes now to that. You've now lost 50% of the 1.5 million, which means you've lost 750,000. Remember, when your million rand equity on the first graph was in place and you gained 50%, you only made 500,000. But if it retracts by 50%, you lose 750. You lose more than you gained. And this is where we call, or what we call, protecting downside risk. Us as an asset manager, what's very important to understand is we want you to make money, and our objective is to grow money. But our other job is also to protect downside risk. And how we do that is we rebalance our clients' investments portfolios and we bank the profits so that you don't become a statistic of this example here. So if you're investing, guys, I urge you, look at your term of the investment. Look at the risk profile that you're going to take over that term of the investment. Understand, is it a lump sum or is it a recurring premium? Have the correct strategy in mind. Make sure that the funds are able to achieve the objectives. You'll never know if your fund was the best fund out of all the funds until the end of the race. And we don't back winners. We're not saying you have to choose the fund and this is going to be the winner. All we want to do is we want to know that the fund that you choose has got the opportunities to achieve the returns you want to get. And we invest in funds that do that. And we run the race and we monitor it on a constant basis. We're checking to make sure the fund managers are doing what they need to do, that they're invested in the asset classes we believe have got opportunities to achieve your objectives. And we rebalance your portfolio to make sure you're banking your profits, you're not losing them when there's market corrections. But a very, very important strategy to have. Guys, I want to thank you very much for listening this morning. I hope there was a little bit of insight that you got in terms of retirement. I don't know if there are any questions. We are in a small group, so I'm more than happy to answer any questions if there are. I don't have all the answers to everything. If I don't have the answer, I will find out and get back to you on that. Any questions, guys? They don't have to be. No? Fantastic.
Gary, it looks like we've got Rita has raised her hand. Rita, would you like to ask anything?
Yes, please. Can you hear me?
Yes, Rita, go ahead.
I'd just like to find out, I'm an aggressive investor and we've got a bit of Bitcoin at this point. I wanted to find out what your feeling is regarding cryptocurrency.
Rita, good question. We are not allowed to advise on cryptocurrency. It doesn't fall under the ambit of our licenses. My personal feelings on cryptocurrency, I don't understand it well enough to invest in it. So for me, I normally invest in things that I understand and things that I can see and touch. So I personally prefer stocks purely because I know the company actually exists. I can get hold of its financials. I can see its balance sheet. I've got an asset manager who runs it. We can see that there's profits. We can see if there's dividends. There's a little bit more control for me personally. That's my belief. With cryptocurrency, it is still new. I think that there is massive opportunities for cryptocurrency in the future. There's lots of talk around it evolving and a lot of people using it as the currency of the future. But as I said, I know very little about it. So I would hate to advise you on it.
Gary, we do have Gary Bartlett on here as well, so I'm not too sure if Gary would like to add to. Gary, you are unmuted.
In respect of cryptocurrencies, the question is where is the correct value? You know, Bitcoin not long ago was $9,000 per Bitcoin. It's now north of $53,000. So is the correct value at 9,000? Is it 53,000? Is it 153,000? And I think that's, as advisors, that's an issue for us. We don't know where the true value lies. But I agree with Gary. I think it will become more and more well used, and even some of the older financial institutions are now looking at, if not using Bitcoin itself, using the blockchain technology in their institutions. So I don't think it's a flash in the pan. I don't think it's just going to go away, but I don't know what the value is.
Yeah. I mean, I still recall, Rita, was a few years back. I was actually at my beach cottage with a friend of mine, Bradley. And I can't remember the exact number, but he said to me, Gary, we've got to buy Bitcoin, man. So I was like, wow, what's going on? He said, hey, it was $22,000 or something, $222,000 for a Bitcoin. Now it's $360,000 for a Bitcoin. These things are flying. When we got back from our holiday, Bitcoin had its first big crash and it dropped down to about, I think it was $146,000. So I phoned him and I said to him, hey, Brad, good news. You know, the dollars that you want, the crypto you wanted to buy, the Bitcoin from $360,000 is now $146,000. Shall we buy? And he said, no, we mustn't buy. So I was like, why not? Because the reality is you must buy when things are cheap and you must sell when they're high. So there was a massive opportunity to buy at $146,000. And Brad's response to me was, I don't know how much further it's going to fall. So to Gary's point, to try and value a cryptocurrency with no underlying assets, it's exceptionally difficult. With a share, at least you can buy it based on a dividend or a yield. You're buying it knowing that there's a specific return you can get on it. But with the Bitcoin, I wouldn't know, and I wouldn't know if Ripple or flippin' Trillion, or I don't know what these cryptocurrencies are called, but I also wouldn't know which one to buy. It's almost, I feel like you can just manufacture one and start one. My kid plays Fortnite, Dylan. He plays Fortnite all the time, and he keeps coming to me saying, Dad, I need to buy V-Bucks. So he's got to use his pocket money to convert into V-Bucks so he can buy a skin or a weapon or whatever it is for these games. And for me, like V-Bucks is a kid's cryptocurrency. It's you converting your rand into a fictitious amounts of money to buy something else. So you might find in the future, V-Bucks becomes the cryptocurrency of choice for the next generation. Who knows? So yeah, but I don't own any crypto. Anyone else have any other questions? Alan?
Yeah. Gary, can you just touch on the difference between the living annuity and the life annuities, just the sort of the salient differences between them?
Absolutely. So Alan, what happens is when you're saving for retirement, you save in a product which is called a pension fund, a provident fund, or a retirement annuity. So that's the savings vehicle. When you retire, you purchase what they call an annuity. Okay, so it's an investment that pays you a salary now. Now, when you retire, there are different annuity options that you can choose from. The living annuity, what that is you've saved up an amount of money. Let's just call it 20 million Rand as an example. You will go and sit with your financial advisor. You will choose the investment portfolio that you would like to invest into, whether it be Allan Gray, Coronation, Quattro, whatever, any unit trust funds you want, or a combination of them. And then you will draw an income from this pot of money. When you draw the income, you are limited between 2.5% to 17.5% of the total fund value as an annual drawdown. So you can draw 2.5% of this 20 million every year as a minimum, or 17.5% as a maximum. And you'll live out of the pot. If there's growth in the pot, in other words, if you drew less money than there was growth, then the pot would grow bigger. So next year, when you draw your 2.5% again, you'll draw the 2.5% off a bigger pot of money. Therefore, your income will increase. You're also allowed to increase your draw once a year. So you could say in year one, I only need 2.5% of the money because I need a small income. I'm actually still consulting for the company I retired from. Come year two, you've stopped consulting. You can then change your draw from 2.5% to, let's say, 5%. And you can draw 5% out of your pot for that year as income. We've got to monitor the pot and make sure that there's always enough money in this pot to sustain you until your life expectancy, and then sustain your spouse until their life expectancy. But you'll live out of this pot of money, and you benefit from the growth of the pot, but you also take the risks if you erode the capital, either because markets crash and you lose money, or if you're drawing too much money. So we've got clients that have come to us with 3 million Rand and said, listen, I need to draw, let's just use an example, 30,000 a month. And we say, look, you can't draw 30,000 a month out of the pot because you're going to erode your capital and you're going to run out of money. And they say, well, I have to have 30, so I'm doing it anyway. So they just draw down the maximum amount, let the 17.5%. They draw the maximum amount because they need it every month. And the capital is getting smaller and smaller and smaller and smaller. And eventually they run out of money. So that's very dangerous if you don't plan properly and if you don't have sufficient money. The other option is what we call a life annuity. Now, a life annuity simply means you don't take any of the benefits of the growth of the investment, but you also don't take any of the risk. What you do is you take your 20 million Rand, you go to the insurer and you say, right, guys, here's my 20 million. How much can you pay me a month as an income for the 20 million? And they will do a quote for you and say, based on your 20 million, we can pay you 8,750 Rand a month, let's call it, just as an example, or 15,000 or whatever it is a month. They'll pay you that amount of money every month, and they will guarantee it for a certain period. Now, you've got to decide with them what that period is. So here are some of the guarantees. We look at you when you retire and we say, right, Alan, are you married? You say, no, my wife died 3 years ago. Okay, so you're single. Do you have any financial dependents? You say, no. Then we would say to you, right, draw a life annuity. Don't worry about all the guarantees, because if you take a guarantee, you're going to get less money. You want the maximum money so you can live life. So you would just take a straight life annuity and go gung-ho. You're still young, you're still healthy, and you want to just spend your money. You could end up at retirement where you come to us and say, listen, I'm retired, my wife is still alive, and I would like to make sure that this income will survive me and survive my wife. Then you would take a joint survivor life annuity. What will happen there is it'll pay you less than the first one, but when you die, it will continue to pay your spouse until her death. If you want a little bit more money than what that one gives you, you could say, right, tell you what, I'll take a living annuity, a life annuity, but I want a guarantee term. What that means is that it'll pay you the income, which is slightly less than the first option. But when you die, it will continue to pay for the duration of that guarantee term. So if you said a 10-year term and you died on year 5, it would continue to pay for the next 5. If you took a 15-year guarantee term and you died on year 5, it would pay for the balance, the other 10. So it is quite complex in terms of choices, but it's actually very simple when you sit with an advisor, because they'll take into account your age that you retire, your health, your marital status, and your income requirements. And based on that, they will advise you as to which options suit you best. Another thing you can do, which a lot of retirees do, is they say, listen, I would like to take a living annuity where I can draw incomes and I can change them once a year. I've got the flexibility to change them because maybe 3 years down the line, you get sick and you need more income to cover extra medical expenses. On the living annuity, you can change your draw. You can say, right, I'm drawing 5%. I need to draw 10% now because I need to cover these additional medical expenses. So you take a living annuity with some of your money, and then the other portion of your money, you use that to buy a life annuity, which gives you a guaranteed income increasing every year with inflation. And when you die, it survives you and your spouse. So you can have a combination of them as well. You don't have to just choose one only. So, but I would advise this only at retirement age and looking at all those circumstances we spoke about. Did that answer your question sufficiently,
Yeah,
Alan?
thank you. Yeah.
Happy, eh?
Yes, thanks.
Perfect. Anyone else? Another quick funny thing whilst we're waiting, if there's any other question, is that there's a regulation called Regulation 28, which restricts the amount of money that you can save into your retirement savings pre-retirement. And you can only put a maximum of 30% of your money offshore and all those little parameters. But when you get to retirement age and you retire, Regulation 28 doesn't apply. And what that means is you can invest your money pretty much anyhow you want to. So if you want to go, if you believe your strategy needs to be more biased around offshore growth and rand hedge, you can actually take your portfolio to 100% offshore if you wanted to. You can go a completely different strategy to what you've had prior to your retirement date. But the pre-retirement savings is governed by Regulation 28, but post-retirement, that retirement regulation does not apply at all. So you can take more risk and achieve more growth. Anyone else? Fantastic. Well, guys, thank you all for listening. I hope we see you on another webinar soon. Roxanne and the team will be sending them out shortly, and we'd love to see you guys on the next one. Have an awesome weekend. Thank you so much.